In today's morning markets, we would like to review the upcoming UK employment data, US inflation and European inflation data. So we'd like to review the events in chronological order in which they'll be posted this week. So that's UK employment first, then US inflation, and finally at the end of the week we get European inflation. So starting with the UK employment report, we get more than just where the unemployment rate within the UK is going. We also get an important component for markets, which is what wage inflation is doing. But starting with the employment side of things, markets are expecting that we see a slight uptick in UK unemployment of only 0.1% to 4.3%. Now, on a historical basis, that's still quite a tight labour market for the UK and should still be supportive for economic growth. But the wage component as well, that is also expected to be supportive for growth. And that is because markets are expecting that number to be about 5.3%. If we consider where inflation in the UK has got to, around 3.2% at the moment, that means we still have positive real wages within the UK, which allows consumers to go out and spend and once again boost economic growth within the UK. And it's for reasons like that why Friday's GDP report from the UK was much stronger than what people had expected at 0.6%. Thinking about the central event for markets this week, which is US inflation, that comes down into both headline and core inflation. So headline inflation expected to be 3.4%, core inflation slightly higher at 3.6%. So follows the narrative that we've talked about previously in these videos, where we've seen inflation momentum in the US rise and also that rate of inflation has been stickier. And that really explains why we've seen those changing interest rate dynamics within the US. At the start of the year, markets had expected by December rates would have been cut 6 times, whereas now, because of that stickier and higher inflation, but also better growth within the US, markets are now only thinking about 1 interest rate cut. And it also explains some of the comments that we've heard from Jay Powell, US Federal Chair Governor, in terms of why they're not looking to cut interest rates and why they believe holding interest rates where they are at the moment is more appropriate monetary policy. Finally, moving on into Europe, they're experiencing much different inflation dynamics to what we're seeing within the US. Growth hasn't been as strong or as robust as we've seen within the US, and that's allowed that rate of inflation to fall faster and further than what we've seen within the US. So headline inflation expected to be 2.4%, so no change relative to last reading, but we're continuing to see core inflation fall, so that's expected to come down to 2.7%. So those rates are much closer to the ECB's inflation target of 2%. And that's what allowed them to talk about interest rate cuts, looking to support growth within the region. So thinking about that, markets are expecting 1 cut on their June the 6th meeting and are assigning a 94% probability to that occurring. So thank you for watching today's video, and we'll continue to provide updates throughout the week.